This is Brooks, and this is my price action trading course. This module is about trading major trend reversal bottoms. A lower low major trend reversal, in other words a bottom, you need a bear trend, and then you need a break above the bear trend line, in other words a break out of the bear channel. Preferably you'd want the rally to be strong enough to reach the moving average, but that's not necessary. After that, you need one more sell-off. You want a test of the bear low. Since we're talking about a lower low major trend reversal, here I'm looking for a test of the prior low that goes below the prior low. And then finally, I want to see a buy signal bar, preferably a bull reversal bar. So the context is a bear trend, a rally above the bear trend line, and then a sell-off, preferably weaker than the sell-off in the original trend, and then a reversal up, including a strong buy signal bar in the area of the prior low. I'm going to use the spider chart, the SPY, the ETF following the S&P 500 stock index, and I'll use a 5-minute chart. Here we're forming lower highs and lower lows, so we're in a bear trend and we're accelerating downward at this point. This is the first bar of today. This is the last bar of yesterday. And the first bar of today, we broke below the bottom of a bear channel. Usually bear breakouts of bear channels fail, so traders are looking for a reversal up. But we have some problems here. Look at the signal bar. A small body, the tail on top is bigger than the body, so that's a weak signal bar. Also, it's following a very tight bear channel with very strong selling pressure. Also, there's no prior significant buying pressure in this bear channel. And we have one little bull body here, we have this one bull body here, but not enough to break above the top of the bear channel, and not enough to hit the moving average. So this is not a strong buy setup. I would wait. Now look what happened. The market reversed back up into the channel, and it poked out of the top of the channel. Poking out of the top of the channel is the trend line, so the market's breaking above the top of the trend line, and we're getting close to the moving average. So this is good buying pressure. The last bar of yesterday, first 4 bars of today, that's 5 consecutive bull trend bars, and 2 of them are relatively big bars, big bodies with closes near their highs. So that is good buying pressure. It's only 4 bars up. In general, I'd like to see closer to 10 bars in the rally, but in the open of the day, first hour of the day, a lot of times major trend reversals happen with fewer bars and bigger bars. So here we have 4 bars and one of them is very big. However, we're breaking above the bull trend line, and we have good buying pressure here, so that's alerting traders to the possibility that any sell-off could result in a major trend reversal. Now there's always a bear case as well as a bull case. The bear case is we pushed up on the last bar of yesterday, we sold off, and now we're pushing up again. So the bears see this as a double top bear flag near the moving average. So aggressive bears might short below the low of this bull bar. I would never do that. With 4 consecutive bars up, I think this could be a trend from the open bull, even though the context is not quite right for a strong buy. I'd like to see what a test down looks like. At this point, with this much buying pressure, I think the odds are there'll be buyers below and the market might form a higher low. But the bears will fight to get a double top bear trend, a double top bear flag, a move below this low, and then a measured move down here. So to me, I'm going to wait to see if we get a higher low, maybe a lower low major trend reversal, rather than take the short. And this is what we have: a very large bear outside down reversal bar, a big gap between the close of the bar and the low of the prior bar. So a pretty strong bear move, and this is enough to erase the buying pressure that we had with this big bull bar. So we have big up and big down. This is a 2-bar reversal. It does not matter that the 2 bars are not adjacent. It does not matter that there are bars in between. This is effectively a 2-bar reversal. and it's a reversal down, so we probably are going to go lower. Most traders don't like to reverse, so either they took the short as the market went outside down, looking for the downside breakout, or and then they'll ignore the long, or they'll not take the short and wait to see if we get a buy setup. Okay, since we have a double top and a bear trend, even with the 4 bull bars, aggressive bears could short 1 tick below the low of the prior bar as the bar is going outside down. It's certainly a reasonable swing short, going for a reward equal to twice the risk. The stop would either be above the high of this bull bar or above the high of the bear bar. However, given that we broke above the trend line and we hit the moving average, we may end up getting a major trend reversal down here, so the bears would have to be pretty quick to get out of shorts if we start to reverse up. Alright, so what do you do at this point? Alright, we have a reversal bar, a close above the midpoint, and a close above the open. It's a small bull body, and on the day it's a high 2. We had a high 1 here and a second reversal up here. Possible evolution into a trading range. Possible lower low major trend reversal. We broke above the trend line, we hit the moving average, and now we're selling off and we're reversing up at a new low on the day. So only 3 bars down on the test of the bear low. Again, in general, you'd like to see 5 or 10 bars up, that breaking the moving average. You'd like to see 5 or 10 bars down, testing the bear low. But on the open, things can happen faster and you can get far fewer bars, but the bars tend to be very big, as they are here. So to me, this is a swing buy, not high probability, so maybe 40%. So if you're taking a 40% buy, you have to be using a profit target that's at least twice as big as your risk. Your initial risk is below the signal bar. Your entry is here. So you take a measured move up, and your target would be somewhere up in this area. If you're short, I definitely would get out of any short at this point, because this is a reasonable major trend reversal buy signal. If you're flat, you could buy here, or you could wait for further evidence that the market has become always in long. At this point, I think the market's still always in short, even though it's on a valid major trend reversal buy signal. Now, look what we have after our entry bar. We have another bull bar. So that's good for the bulls. We might be forming lower highs and lower lows, and we may be channeling down. But at this point, we're getting far too many bull bodies, and big bull bodies, for me to look to short. So I personally would not look to short. And at this point, I think the market's probably always in long. We have a good entry bar and a good follow-through bar. So at this point, I think if you did not buy above the high of that bar, it's okay to buy the close of this bar and maybe put a stop below the bottom of the 2-bar bull spike. You could also keep a stop below the bottom of the day, the low of the day. For the bears, they might short below this bar, thinking that it's another lower high in a bear channel, and that it's simply a pullback from this strong bear breakout to a new low of the day. I personally would not take the short, because we're getting far too many bull bodies, far too much buying pressure. This is a very good bar for the bulls, a very big bull trend bar, closing well above the high of the prior bar, and above the high of the bear spike, and above the highs of the past 15 or 20 bars. So that's a very strong bull reversal bar, and probably will have follow-through buying. At the moment, I would look for a measured move up based on the height of this first leg. Since it's always in long, and it's the breakout phase of a bull trend, the probability is 60% that you'll get a measured move up. The initial risk is down to below the bottom of the spike, so if you bought this close, your profit target probably would be lower, maybe around here. You could already exit with a reward equal to your risk. If instead you view this as a breakout above this weaker leg up, you try to get a measured move up here. Also, we have a magnet up here, a prior lower high, and this target is below that magnet, so it's probably worth trying to get out at that point. It's possible that this is simply part of a buy vacuum test of the top of a trading range, but if it is, we probably have a little bit more to go because there's room up to that prior lower high. So we have a trend line break, a lower low major trend reversal, always in long, probably on the close of this bar, certainly by the close of this bar, and now we have a pause bar. We have 6 bars up without a pullback. I think there will be buyers below the low of this bar, with either a stop below this low, or better, a stop all the way below the bottom of the bull spike. And there may be buyers above the high of this bar as well, because we have room up to that lower high. So it may be a 1-bar final flag and the start of a bigger correction and a transition into a trading range. In any case, if you bought this close or above this bar or above this bar, I would be holding long and trying to get a measured move up based on the height of this first spike up. And the market went slightly above a measured move based on the height of the low of the signal bar to the high of this first leg up, and then had a strong bear bar, a pause, and then a second strong bear bar. We're in breakout mode here. We have 3 consecutive inside bars, 1, 2, 3, and arguably a high 2 buy. We went down and then up and then down, and technically this is a buy signal. To me, I would be concerned that we're getting pretty close to the top of the trading range and we have a very strong bear reversal bar. Plus we have another bear reversal bar. So I would make sure that I took off at least half of my profits, either up here at the measured move target or on these strong bear closes. You could short also, or not short. You could exit also below the lows of those bear bars. Protective stop at this point, you could have it below the signal bar or below the entry bar. I would not put it below the low of this bull bar because it's possible that we just channel down and the bottom of that bar will be a magnet. Everyone knows there are stops below it. So I would not put a stop there. I would either put a stop below the entry bar or below the signal bar. Or I would get out of part or all right here. I think it's okay to get out of all and maybe look to buy a higher low major trend reversal. Remember, after you have a lower low major trend reversal, you usually end up getting a higher low major trend reversal. We have a strong bear breakout, but look at the follow through. The follow through bar is a doji bar and not another strong bear bar. So this may be a failed bear breakout, and it might simply be a test of the breakout above the high of this bar. Remember, this is a breakout and it's a gap. The gap is between the high of this bar and the lows of these bars, and this bear bar is testing the bottom of that gap. So this could simply be a sell vacuum test of support, the bottom of a gap. And you could also argue that it's a higher low major trend reversal after the lower low major trend reversal. However, this is not a strong buy signal bar. It's certainly not strong enough to reverse the effect of this strong bear bar. So I personally would not buy above this bar. I would wait to buy. So had I gotten out of all of my long position up in here somewhere, I would be currently flat waiting for more information. If the bottom of the bull spike fails, you'd exit, maybe around break even, or if the bear clearly resumes. If you do exit, you have to be ready to buy again. If you're still long part of your position, you'd look to buy more on a higher low major trend reversal, especially if there's a good signal bar. Sometimes you have to have several attempts before the trend resumes. So sometimes the first setup does not work. Alright, so look what happened. The market had one more push down. Very often when you have a strong breakout, you have a second push down, and that's what we have here. But now we have a very strong bull reversal bar, and arguably 3 pushes down into a wedge bull flag. 1 push down, second push down, third push down, and a strong bull reversal bar. The context is good, a potential higher low major trend reversal. The market never flipped to always in short on these bear bars. They were immediately followed by pauses or strong reversals. and we're now forming a higher low. You can see how it dipped right below the bottom of the big bull breakout bar. A lot of times it does that to run stops, break-even stops on weak longs. And now we have a strong bull reversal bar. So I place a buy stop above its high to get long, or to add to my long. I was not filled on this bar, but I would have been filled on this bar. And the new stop is below the low of that strong signal bar. First target would be the top of this channel down. Next target would be a new high of the day. And possibly a leg 1 equals leg 2 measured move up. Leg 1, the bull spike, and then a pullback, and then leg 2 would be a second leg up, about the same length as the first leg up. And this is what we got. We got a bull bar, bear bar, bull bar, bear bar, bull bear, right? That is not a strong bull trend. So when you see that, it's probably a bull leg in a trading range. So instead of this being a strong bull trend, at this point I'm assuming that the market is in a trading range. And in a trading range I want to buy low, sell high, and scalp. I bought low, and now the market's high, so I'm thinking about selling. I'm not willing to sell to go short, but I am willing to sell to get out of longs. We have a micro double top, a small flag that failed, and to me I would get out of longs probably below that bear bar, and I would have been filled over here. As far as buying this as a high 2 or a high 3, I would not buy it. I think this looks like a bull leg in a trading range. It's not strong, it's not consecutive big bull trend bars. It's alternating bull and bear bars with pullbacks along the way and small bodies, and we're stalling out around the prior high. So for me, I would get out of longs. It's not strong enough for me to short, but I would get out of longs and look to buy again lower. Maybe we'll form a large triangle. You could stay long and with a stop below this higher low. You would not want the market to come down below that higher low, because most traders got long probably right around here. This fell below their entry price, and they would not want the market to come back down there a second time. And this is what we got. We got bad follow through for the bears. All right, that's terrible follow through for the bears. Another bear breakout, small bar followed by a bull bar. And this low is a test of this signal bar high. So this sell-off might simply be a sell vacuum test of support, the high of the strong entry bar, signal bar, bull signal bar. We have a failed bear breakout. This bull inside bar creates a failed bear breakout. You could buy above its high. We have a little breakout of that buy signal, and then a pullback and another buy signal. It looks to me like we're forming a triangle. We're forming higher lows, not yet higher highs. The market stayed always in long. We never went short, and looks like we're testing a support level, the high of this very strong bull reversal bar, and we're turning up. So I would buy above this bar. I would buy above this bar. And look what happened on this leg up. We got a bear reversal bar near the top of the developing trading range. So we may be forming a triangle, and we may get another push down. Trading range, buy low, sell high, scalp. I would sell out of longs. I don't know that I would necessarily sell into shorts. I think we're always in long. And here we have 8 or 9 bars up, 8 bars up without, or 7 or 8 bars without a bear body. So even with this bear reversal bar, I would not take that short. We tried to resume up here. This is a pullback from this breakout. So, a potential buy here. But to me, this is a real problem. We tried to break out of the trading range, and we have a big tail. Remember, every tail is a failed breakout of something. So we have a failed breakout and then a strong bear body, outside down. I don't think I would go short. I think the range is becoming tighter. This is not a strong sell setup, and we're getting late in the day. But I would exit any remaining longs probably below the bottom of this outside down bar. I would not want to see follow through from that reversal. I'm going to go through the same slides, this time with no notes on the slides. There is another series of charts after all of this, and I'll discuss those when we get there. Now I'm going to talk about a double bottom major trend reversal using bond futures. Clearly we have a bear trend that's contained by a trend line. It's in a channel, and we may be forming a slightly lower low here and a reversal up, but since we have not clearly broken above a trend line, I would not be buying this. You could argue that we have a bear trend here and a trend line break and a lower low major trend reversal. I don't think that's very much buying pressure, and this is not a good looking signal bar, so I personally would not take that buy. Alright, so spike in channel, bear trend. Channels usually evolve into trading ranges, and you might get a reversal up, and the rally may go all the way to the top of the channel. Okay, channels often have 3 pushes down, and there's often a failed bear breakout through the bottom of the bear channel, followed by a reversal up. You know, you've got to be looking for signs of a bottom whenever you see a bear channel. Okay, also if we do get a reversal up, you should start looking for signs of a major trend reversal. You want to see a break above the bear trend line, and which is the top of the channel, a test of the moving average, although that's not necessary, and then you want to see a sell-off that goes down and tests the bottom of the bear. That's your context, and then you want to see a signal bar, a reversal up again, and that would be that would complete the buy setup. So we had a bear spike, this green box, and then a channel down, and we had the first push at the bottom of the spike, a second push, and a third push. It does not matter that the third push is trying to turn up from the bottom of the channel without actually touching the channel. Sometimes that happens. To me, I think this is not a good buy, and I would wait. However, what is taking place here is buying pressure. We're getting a break above the bear trend line, the top of the channel, and we're getting consecutive bull trend bars closing on their highs. And here we have a gap bar. There's enough buying pressure so that the low of this bar is completely above the moving average. Very often when you have a gap bar in a bear trend, it leads to the final leg of the bear trend. So some bears would short below the low of this bar, betting that the market would come down and test the bear low. So gap bars often lead to the final leg of trends. So we have the break of the trend line, the test of the moving average. Next, we need a test of the bear low. So we need the bear trend to resume, and then we have to look to see if there's a failure around the old low, and you want the shape to be reasonably good. If the rally was 20 or more bars, you want the bear test of the bear low to be 5 or 10 bars. So if that rally goes up for let's say 20 bars, and then it just drops for 2 bars, I would be suspicious that the shape is not good enough. We'll probably have to test down more, and I probably would not buy that test down as a higher low major trend reversal. You want the sell-off to be weak. Okay, you don't want a series of very big bear trend bars. You'd like it to be 2 or more legs, and you'd like to see some buying pressure along the way, like tails at the bottom of bars and maybe some bull bars as the market is selling off. This is what we got. We have a pretty strong bear sell-off, not what I typically would like. However, we're double bottoming at the prior low after breaking above the trend line with 2 good bars closing on their highs. We have a gap bar here, so bear is shorted 1 tick below its low, and gap bars very often, most of the time, lead to the final leg of a bear. So I think this is an aggressive buy because the signal bar is a bear body and the sell-off was such a strong bear spike. It's a bear micro channel. But I think you can buy this. Maybe your probability of success is 40% or so. Your protective stop is 1 tick below the low of the bar. The bar is 2 ticks tall, so you entered 1 tick above, and your risk is 4 ticks. Since you're taking a setup, if you're taking this buy, you're taking a buy where the probability is only 40%, you need to go for a reward that's twice as big as the risk to get a positive trader's equation. So you need a profit target that's 8 ticks above your entry price. Okay, what does the market need to make traders believe that it's always in long, that it's going higher? They either need a big bull entry bar, if the context is supportive, and here the context is. It's a possible double bottom major trend reversal. If you don't get a very big bull entry bar or bull breakout, maybe you'll get 2 or 3 or 4 consecutive bull bars that are not necessarily big, but they're still consecutive bull bars. You also want to see a break above the moving average. The setup itself is not all that strong. We did not have much buying pressure, and we have a weak signal bar. So I would make sure to take at least half off, maybe the entire position off, at 2 times the initial risk. Here's the signal bar. The stop is 1 tick below its low. Here's your entry price. The risk is 4 ticks. 2 times the risk is 8 ticks, and the market went 1 tick above the profit-taking limit order, so I would take at least half off at that price and then wait to see what happens. We did not get a strong bull bar here, but we did get a big one here, and we did go 8 ticks above the entry price. So bulls could have scalped out with 8 ticks while risking 4 ticks. So what do you do now? The bears see this as a large low 2 legs up and a bear trend, and they're expecting this to result in simply a broader bear channel. So they'll draw a trend line from this high across this high, betting that the trend will continue down. If I were long, I probably would get out below the low of this bar. So I would have scalped out with 8 ticks up around here, and then with the second attempt down, the market might be transitioning into a trading range. I think it's reasonable to go flat or put your stop back to break even on the remaining half of your position. If a setup is not quite good enough, wait. You either wait for a second signal or a strong bull breakout. After a double bottom major trend reversal, the bulls are going to try to form a higher low major trend reversal. Remember, most major trend reversals have low probability, maybe 40 to 50%, and usually the entry bar does not trigger an always in reversal. You need a breakout after the reversal triggers. To compensate for the low probability, you need to swing. You need to take a reward that's at least twice the size of your risk to get a positive trader's equation. You can only take a trade that has a positive trader's equation, or else you're going to lose money. Do you allow pullbacks once the market's turning up? Whenever you take a swing trade, you're looking for 2 or more legs up. And if you have 2 legs up, 1 leg up, pullback, 2 legs up, that means you have to be willing to allow pullbacks. So whenever you're swing trading, you're always allowing pullbacks. And that means don't tighten your stop too soon. The first pullback often goes down below the entry price to trap out the weak longs. Strong bulls keep their stops below the most recent higher low. The sell-offs often come from strong sell signal bars, and they tend to trap weak bulls out and trap weak bears in. When swing trading, don't be fooled. Rely on your protective stop and don't be trapped out of a good trade. Alright, so this is what we had. We had a sell-off and a reversal up. Not a very good looking signal bar, but notice what happened here, right? Your entry price was right here, and this pullback missed hitting break-even stops for the bulls. So it's a higher low major trend reversal buy setup. Arguably a wedge bull flag. We had a push down here and then up, a push down here and then up, and then a push down here and then up. So to me, this is a higher low major trend reversal buy signal. So if traders did not buy here, if they did not buy here, they can take a swing trade here. Again, bear signal bar, not good for the bulls. That lowers the percentage, maybe to 40%. If traders bought here and exited, let's say, half here, they could put their half back on again, their second half back on here. Once the bull resumes, you raise the protective stop to either below the most recent higher low or to break even. Most successful traders will not let the market come back to their entry price a second time. Since the probability is only 40% or so, you need a reward at least 2 times bigger than your risk. So you place a sell limit order to take partial profits, maybe half, once the market reaches a target that is twice as many ticks as in your protective stop. At this point, we're getting late in the day, and if you bought the higher low major trend reversal and you're trying to see if you can get out at 2 times your risk, you have a limit order to exit up here. However, you have a problem. We're running out of time in the day. You don't want to give back all of your profit, and now we have 3 pushes up, so this might function as a wedge bear flag. I probably would not exit below the first attempt down, but at this point it's another bear bar closing on its low, bear bar closing on its low, second attempt down, second failed breakout attempt above this high. I would probably go flat and just stay flat for the rest of the day, even though the market did not reach my target. And that is the end of this module on trading major trend reversal bottoms.